Hey there, folks! Welcome back to another enlightening episode. Tonight, we're diving into the exciting world of, wait for it, transfer pricing. Don't touch that dial, I promise. It's more fascinating than it sounds. I know, it sounds about as thrilling as watching paint dry, but trust me on this one. Once you get the hang of it, you'll see how crucial and interesting it really is. Transfer pricing is one of those things that seems super complicated, but once you break it down, it's actually pretty straightforward. It's like solving a puzzle where all the pieces fit together perfectly. Basically, it's all about how companies price stuff they sell to each other, especially when they're in different countries. Imagine a company with branches in the US and Japan. How do they decide the price of goods exchanged between these branches? Think of it like this. If your left pocket sells a crumpled dollar to your right pocket for $5, something's fishy, right? It's like playing a game where you set the rules to benefit yourself. That's transfer pricing in a nutshell, making sure companies aren't inflating prices to dodge taxes. It's about fairness and ensuring that every country gets its fair share of tax revenue. Now let's unpack this a bit further, shall we? We'll explore how transfer pricing impacts global trade, the economy, and even the prices you see on store shelves. Stay tuned, because by the end of this, you'll be a transfer pricing pro. Transfer pricing isn't just a corporate buzzword, it's a vital part of international business. It ensures that companies play fair and that governments can collect the taxes they need to provide services. So next time you hear about transfer pricing, don't yawn and tune out. Remember, it's a key player in the world of business and economics. And who knows, you might even impress your friends with your newfound knowledge. Thanks for joining us on this journey. Until next time, keep learning and stay curious. Picture this. Big company. A makes awesome sneakers for $20 a pop. These sneakers are crafted with precision and care, ensuring top-notch quality that customers love. The factory buzzes with activity as workers diligently assemble each pair, contributing to the company's stellar reputation. They have a subsidiary in a country with lower taxes. Let's call it Tax Havenia. This picturesque location isn't just a tropical paradise, it's also a strategic financial haven. Companies often set up subsidiaries here to take advantage of the favorable tax rates, which can significantly boost their bottom line. Now, Company A sells those sneakers to their subsidiary in Tax Havenia. This transaction is more than just a simple sale. It's a carefully planned move in their financial strategy. The sneakers are shipped overseas, and the subsidiary takes ownership, ready to distribute them further. Here's the kicker. They could sell it at a reasonable price, around $25 to make a fair profit. This would ensure a healthy margin while keeping everything above board. But, as we know, business isn't always about playing it safe. But, where's the fun in that? Instead, they decide to get a bit creative with their pricing strategy. Instead, they decide to sell it for a steal, a mere $22. This price is just low enough to raise eyebrows but high enough to keep the operation running smoothly. It's a clever move that sets the stage for the next part of their plan. Why? Well, by making the subsidiary in Tax Havenia look super profitable, they can potentially pay less in taxes overall. Sneaky, right? This maneuver allows them to shift profits to a location with lower tax rates, effectively reducing their overall tax burden. It's a classic example of tax planning at its finest. Hold on, we're not done yet. There's more to this story than meets the eye. There's this little thing called the arm's length principle that tries to keep things fair. This principle ensures that transactions between related parties are conducted as if they were between independent entities, maintaining market integrity. More on that in a bit. We'll dive deeper into how this principle works and its implications for companies like Company A. Stay tuned as we unravel the complexities of international business strategies and the fine line between smart tax planning and crossing ethical boundaries. Alright, back to that whole arm's length principle thing. Imagine you're buying a used car from your best buddy. Are you going to pay the same price you'd pay a random dude on Craigslist? Probably not. That's where the arm's length principle comes in. It basically says that companies have to price things as if they were dealing with independent companies, not their own subsidiaries. No sweetheart deals, no funny business, just fair prices, like you'd find in the real world. Makes sense, right? Now, you didn't think we'd talk about transfer pricing without mentioning the big dogs, did you? That's right, even tech giants like Google have to play by the rules. Well, sort of. A while back, Google got into a bit of hot water with the Australian government over their transfer pricing practices. Seems they were shifting profits to low-tax countries, And let's just say the Aussies weren't too thrilled about it. It was a whole big thing with lots of legal back and forth. The takeaway? Transfer pricing is serious business, folks, even for companies that seem invincible. Section 5. The good, the bad, and the transfer price. Look, transfer pricing isn't inherently evil. When used correctly, it can actually help companies streamline their operations and be more efficient. But, like with most things in life, there's always the potential for abuse. That's why governments around the world are cracking down on dodgy transfer pricing schemes. No one likes a tax dodger, especially when it comes to multinational corporations. So, companies need to be careful and make sure they're playing by the rules. Section 6. The price is right? Or is it? Transfer pricing disputes. Here's the thing about transfer pricing. It's not always black and white. Sometimes companies and tax authorities disagree on what a fair price actually is. This can lead to lengthy and costly disputes with lots of lawyers and accountants getting involved. Not exactly the most exciting way to spend your time, is it? That's why it's so important for companies to get their transfer pricing right from the get-go. Section 7. Keep it clean. Documentation is key. Remember what your mama always said? Document everything. Okay, maybe she didn't say that, but when it comes to transfer pricing, documentation is crucial. Companies need to be able to justify their pricing decisions with solid evidence like market data and comparable transactions. Think of it like this. If a tax auditor comes knocking, you want to be able to show them you've got nothing to hide. Otherwise, it's your word against theirs, and we all know how that usually ends. Section 8. Transfer pricing expertise, not just for accountants. Here's the thing about transfer pricing. It's not just an accounting issue. It involves understanding complex regulations, economic principles, and even a bit of international relations. That's why companies need experts who can navigate this tricky landscape. It's like putting together a puzzle. You need all the right pieces to get the full picture. Section 9. So, you think you understand transfer pricing? Congratulations, you've made it to the end of our whirlwind tour of transfer pricing. It's been quite a journey, hasn't it? From the basics of what transfer pricing is, to the intricate details of how it impacts global business operations, we've covered a lot of ground. Hopefully, you now have a better understanding of what it is, why it matters, and why you should care, even if you're not an accountant. Transfer pricing isn't just a dry financial concept, it's a critical tool that helps ensure fairness and compliance in the global marketplace. Just remember, transfer pricing is a complex and ever-evolving field. Regulations change, economies shift, and what works today might not work tomorrow. Staying informed and adaptable is key. So the next time you hear those two little words, don't run for the hills just yet. Instead, see it as an opportunity to delve deeper into the mechanics of international business and finance. Take a deep breath, channel your inner economist, and remember, it's all about keeping things fair. Fairness in pricing ensures that companies pay their fair share of taxes and that no one is unfairly advantaged or disadvantaged. And on that note, I'll leave you with this thought. If a company is willing to go to great lengths to avoid paying their fair share of taxes, what else are they willing to cut corners on? Think about it. Ethical business practices are the backbone of a healthy economy. Transfer pricing is more than just a financial strategy. It's a reflection of a company's values and integrity. When done right, it promotes transparency and trust in the business world. So, next time you encounter transfer pricing in your professional journey, remember its importance and the broader implications it holds. It's not just about numbers, it's about fairness, ethics, and the global economy. Think about it.